Hello traders, in this section we will discuss the advanced view of day trading, reading the tape, getting all pieces together to maximize profit. And this section requires a very good understanding of what we discussed in the trading course, the bias, the setups, the structures, the volume profile and auction. And then here we take the scalping on the tape to confirm our directions, and we take small price fluctuations and generate higher percent profit. But please do me a favor, if you didn't see the intro part 1 in our course, please go back and review the intro at the how prices move section, and make sure you fully understand how prices move in any market between the bids and asks, because everything we'll discuss here today is based on this information. I don't want to go back to discuss that again. It's already been explained. So please go back to the intro part 1 and review how prices move section. Scalping trading. Scalping is the trading method in which traders make profit on every small change or fluctuation in the price of stock. So we really capitalize on very small movements in stock, 5 cents, 10 cents, 20 cents, in a very short frame of time. We're in and out in seconds or minutes by maximum. And we capitalize on those small percentage of profit, of course, using the cash account or the margin. Scalping, pros and cons. Why scalping? Less exposure equals less risk. The less time you have in your trade exposed to the market, the less risk you have. This is why scalping, the seconds to minutes by max, we just capitalize on the bounces or reversals very quickly by relating the tape to the auction. Second, the ability to take advantage of many rotations, which represents more opportunities. How many times you as a trader, you're sitting in front of the screen, and you know that the price have to move or jump from this price to this price, but you don't see too much profit in it, or you see too much risk in it, so you try to avoid it. We see this scenario over and over again during our trading day because we're waiting for the bigger setup. But really, with practice, reading the tape and relating to the auction, we can capitalize on those small fluctuations. The efficient use of margin. It allows you to use your margin very efficiently by reducing the risk to the minimum and taking those pauses in seconds or minute and capitalizing on profit. So there is a lot of opportunities there to use your margin efficiently. What are the cons? Takes a lot of practice. Well, scalping is not a skill you can learn in a day and a night. I'll give you headlines, I'll give you a heads up for scalping and how we do it, but practice. As we always say, smart practice what will get you there. You cannot build a skill just by absorbing the information. You need to put the information in practice over and over again, and I recommend at least 2 to 4 months practicing post-market or pre-market or during the market hours, reading the tape and relating it to the auction levels. High commissions, of course, scalping, because we generate over 20 round trips a day, round turns in trading over 20, so it generates a lot of commission. So that's a disadvantage. Scalping without discipline is a recipe for disaster. If you're not disciplined, if you don't have a good base to build on your scalps and read the auction, it's a recipe for disaster. You won't be able to control your risk, and it's not really suitable for everyone. You are trading against HFT and institutions with edge. We're missing the word with a sharp edge. You are trading against HFTs, high frequency and automated programs and computers and things with a huge edge against you. Speaking of speed and technology, so you already have tough competitors in this zone. You have to know what you're doing before you execute. Sharp edge including speed. Here's the second part. Here's the mistake. With a sharp edge including speed and technology. Here comes the skill. Reading the tape and interacting with key auction levels requires a lot of practice. Reading the tape and relating the story to the current structure. That's the skill that you need to practice and you need to build on to improve. We focus on identifying who's covering, squeezed, taking big position, hidden buyers and sellers, dark pools, aggressive sizes, selling, trading against the technical analysis. All of that, you have to build a skill and reading the tape to extract this information. All this information can only be extracted from the tape. Best way to practice is to record your trading, tape and charts while you during the live markets, and review post-market hours. This allows you to slow down the action and build a better view of how to interact with the tape and key levels. So back again, you need to build a smart practice system by recording your screen, the tape and the charts, and how the levels move between the auction levels, and how to capitalize on those bounces. Where is the opportunities? Where is the less? Where is the low risk ranges? Preparing for the day. Before you get into scalping, you gotta be prepared. The process of preparing we discussed already in the course is the same process. We follow the same exact process of trading the live wire setups. We'll go through them quickly here. The bias, pre-market planning. You have to identify your watch list, what stocks you need to watch, and what's your direction on these stocks depending on the big time frame auction levels. Volatility, you need the stocks that move. You need volatility, because volatility means opportunity for us. So you need volatility, and you need stocks with volume probably over 400,000 shares, 500,000 shares minimum. Identify key auction and interaction levels. So after planning and defining your biases, you have to define what levels you want to trade against. Speaking of the low volume nodes, the values, and all of that. Confirm your scalp direction from the tape. So once you start scalping, you need to use the tape in your favor to confirm the trades of your levels. You will see the tape always reacting to the levels that you already planned. So if you don't see reacting in your way, you don't take a position or say no to the trade. If it's acting your way, you can have a quick scalp here. Set up your hotkeys. Your hotkeys here is an edge, because you need every element of speed here. You're already trading against HFTs, you're trading against professional traders with technology and all of that. So they're already ahead of you in a speed edge. So what you can control, you better try your best to get the best out of it. So hotkeys will help you to execute faster in and out of setups, scale sizes, get in, get out, set limit orders, market orders, and all of that. By mouse, it usually take couple of seconds more, and we really need those seconds. Every seconds here mean extra profit or loss. A lot of HFTs and institutions have an edge against you with speed. So secure the best tools for execution speed by securing a good internet, and usually using the wire is the best option. Don't usually use a Wi-Fi for that. A strong laptop, a gaming laptop maybe, and also the hotkeys. Of course, also the environment that you're trading in. Try not to scalp in a noisy environment. All of that affects your focus, because scalping requires a high degree of focus that swing traders or longer trades that take 20 minutes to hours takes usually. So we usually try to secure an environment where we can have a full attention to the tape and the auction trading. Reducing your risk. First of all, commissions is the biggest problem in scalping. So try to get a broker who can give you a good commission structure. Speaking of generating 20 round trips, 20 round turns a day or more, you will need a good structured commission. So find a good broker that can secure that. And if you need an advice, please contact me at livewiretrading.main@gmail.com, and I can give you a lead to a good broker. Size your trade correctly. Size. Here you're scalping in seconds. You're taking 20 round turns, and you cannot make mistakes with too much size or too less size. You need the absolute correct size for every trade, so you can trade without looking at your P&L. Looking at your P&L during scalping is also won't help. It's more of a disadvantage in your favor. So try to hide your P&L. Try to focus on charts. try to count your size and just trade what you see on the screen. Try to count your stop losses and risk mentally, and of course the skill will develop by time. So sizing your trade correctly will help you to risk manage every scalp, because without risk management, if you don't have a risk management edge on these scalps, you have no edge in general, no matter how good is your win accuracy. Discipline is to stick with what you're doing. You cannot turn a scalp into swing trade because it didn't go your way. You cannot do that. So discipline. You have to stick with your plan, and you have to work a risk management, maybe a scale out plan. If you're not in flow with the market, you start reducing size. Actually, this is the opposite of what traders do emotionally when they start losing. In scalping, if you're not in flow in the market, if you're losing, you have to keep reducing to trying to stay in the game as long as you can, because you're trying to gain that flow with the market. Once you get the flow in the market, you will be able to generate that risk back and profit. The technicals. Now I'm done with the slides. I will take you through charts, and through the technicals I will take you through the LVN bounces, the values. Of course, this is volume profile based, so if you didn't view our course, please, I highly recommend you to go take the course, understand the auction and how volume profile as an auction tool works. We will discuss fake outs and breakouts, live wire setups. Of course, also that's discussed in the course. The VWAP, short, long squeeze, X patterns, the washout, reversals, as these are the main areas we look for scalps. And there is even more, but this is the main focus for us. So let's take the attention to the charts now. But before we move to the technicals, I would like to talk of institutions and how things really work in pre-market, and just a quick discussion here. Institution behavior, you have, this is the yellow area on my trading view, is usually a pre-market. You have to know that pre-market you can easily move prices because there is not much volume, and even with the small capital you can move prices aggressively. So think about whoever can move prices pre-market and how they take it in their advantage. So when prices move like this pre-market, usually traders get a FOMO. Once the price comes back, they want to long the stock, and there is always agenda behind these moves. You will never know what's the agenda, but reading the tape and level 2 will help you get a good image about the move that happened pre-market and what's the purpose out of it. So the pre-market moves usually are manipulated for a purpose, even for a push lower or higher. But the market is always, as we say, the market is designed to take the amateurs' money. By moving the prices up and down with the small cap and post market, you usually get traders who are holding position from previous day to panic, and this is the reason why once the market open you see big candles up and down, because there is a huge interaction between the panic sellers, emotional buyers, emotional technical analysts, the people who want to jump in, not miss the opportunity, and the people who's coming from the previous day emotionally, they just want to make back their losses, or just excited because they made profit. So the first 5 minutes is the most volatile frame of the day. This is why the reason once at the 9:30 US time you see these big moves. In this case, we're here looking at XBIO. This is one of the stocks that pre-market hit from $115 to $180. Usually stocks halt or stop trading, which is limited. Low caps like this and $1, it usually halts after 1 minute. So the halt usually is the exchange stops the trading after the stock hitting 20% or above during the market hours. So it stops to give the investors time to rethink and not to panic because of the prices movement. So as you can see, from 115 to 180, and when the market open at 129, market ranges start washing out the buyers by this candles, getting the buyers out and getting shorts to get position. And of course, whoever can move the market will take advantage of this pool around here of buyers getting out, taking their position, and shorts losing their position also, and then flushing everybody out of the market, and then boom, the move happened. So you have to look at these markets from a perspective of someone squeezing the markets, trying to get the winners out of the market and try to get as many sellers. If they're buyers, they try to attract the sellers as much as they can, because if they're buying, they need size to sell for them. And if they keep buying without driving the public emotionally to sell, they will actually lose money by moving prices higher the bigger they buy. So always think about who's squeezed in the market, who has the big size, who's short covering, who's in pain. All of these gives you a good indication. And from reading the tape, you can actually spot these things. There is things you cannot spot on the chart through the candle movements. This is just for theoretical trading, but reading the tape will give you the actual story happening in the market. Even if there's hidden buyers and sellers on the tape, you can easily spot them with experience, of course. And at some areas, like market doesn't just flush retail traders or day traders. There is the option traders. When the market ranges in ranges like this, you have the option traders. So these ranges doesn't just kill the day traders, it kills those mini flushes. Of course, gets the short and buyers hit their stop losses, but the options trader, they get killed here because they are restricted to a time frame. If the prices doesn't move in this time frame, they lose their option premium. So markets moved in a way to extract money from all these sides. So you have to put that in mind. Who's squeezed? Is it option trader? Is it the shorts getting squeezed? Is the buyers trying to wash out? And all of that. So reading the tape will give you an indication of what's happening here. Dark pools at some point. Let's see if I. At some point, you will have here on the tape, you will have prices coming between 10 and 11. Let's say you have which is the decimals under pennies. I mean between 10.10 and 10.11, let's say. Between 10.10 and 10.11, you will see prices executed that you cannot trade yourself. This is dark pools, and institutions and funds are able, because of their tools and programs they can, and the brokers they deal with, they can actually execute in these ranges where you cannot execute. But always from the size that goes on time and sales, you can always find a lead. Yeah, just a second. Let me. Yep, I just needed time and sales. Let me bring time and sales view here so we can see what's the time and sales. Sorry, I'm trying to find the screenshot I took earlier. Hold on. All right, this is an example for time and sales. Time and sales is not like level 2 or reading the tape. Time and sales shows you what really executed in the market. So we don't really care of who bought or who sold. We just know at this price 29.10 there is a 400 shares executed. Executed means there is a buyer and there is a seller. You cannot say who sold or who bought. Is it bought or sold? For every buyer, there is a seller. And the time and sales here shows you what exactly executed in the market. So you don't come to this 400 and see if, who bought or sold. We're not interested. We're just seeing the size executed and did it lead to move the prices higher or lower. So we only care about the sizes and how it affect the market. So you can spot the dark pools, you can spot who's going aggressive in the market, you can see who's actually in control, if it's the buyer or sellers during the shares executed, and how it affects the price movements. So at some point, let's say there is, let me bring level 2 here. That's a bad screenshot here. Now let me find another screenshot from what I have. I'm trying to find a level 2 screenshot from now. The market is now closed. And I cannot really give live examples, but we can. Yes, here's a one. That's level 2, and how we relate this with the time and sales. So technically, on the right here, you can see the time and sales, and on the left, you can see the tape, which is the level 2. Also, you can see the time and sales here on this side, so we don't need this screenshot anymore. We can focus on this one for now. This is the time and sales. This is the actual prices executed in the market. So at 205, 100 shares just executed. So we have a buyer and seller for this execution. And these are the bidders and asks. These are the limit orders, the waiting buyers and sellers at the market. So as you can see, the exchange and the bid price and the size waiting. So at 205.61, there is a buyer's waiting with 200 shares. At 205.63, there is 125 shares waiting to be sold, and the difference between this 61 and 63 is the spread. Some institutions and platforms can execute between these prices, 61 and 63, where you cannot execute, but you can see the execution between these prices here, and you can build a theory of what is happening. Most of the time, there is a lot of fake orders posted here by HFTs, so you see a lot of fake orders. You will see a lot of hidden buyers, like let's say a bidder here, we have a lot of size waiting to buy, but they actually cannot move the market higher. You see no asks here, but the market, instead of these big size of buying, the market is moving down and flushing them. That's an indication of a hidden seller, and you usually see it here. Executing a big size and moving the market down. That means the hidden seller. We have to consider that and mark this on the chart. If we go back to that level. So hidden buyers, hidden sellers, dark pools, HFTs and fake orders, all of that, I know it's hard in the beginning, but you can easily spot later with enough practice, enough market screen time with the level 2. So you gotta spend daily hours in front of recording level 2 screens and just watch it over and over again till you get it. There's a lot of things that goes on during the day, but when you don't have this supporting your auction view, I will give a quick example now on a chart. So of course this is not the level 2 of this chart, but I'm just showing an example here. So let's say, let's take an example here. Let's start from the beginning. So what really interests me in how to relate the story when I trade the volume profile, first of all, the LVM bounces. So if I have a chart running and we have a volume profile, the most areas that interest me, really speaking of auction and volume profile, are these areas where you have a very thin low volume node between the volume profile. This is usually the strongest, and I usually expect a bounce of them. So if I have a plan to take advantage of this LVN where the public reject prices, I have a plan now to take a bounce, even though we have a big red candle. So I have a plan, let's say, to buy the 171. Now I go to the level 2 and see if the bidders supporting me on that decision. So I wait for my price 171 to come, and I wait for the bidders here to start. This is usually a very quick move, so you have to be a quick thinker and requires a quick act. Once you see the bidders jumping in on that price that you required, you immediately take your position and take the first bounce of the chart, which is here. In this case, it jumps from 172 to 180. Once you see the change coming again against you, you just get out of your position without even thinking. So LVN bounces is an area that I look at, but you have to plan it. And usually when I take LVN, I take 2 to 3 cents maximum risk on the trade. You cannot violate that. Faking out the structure. A lot of people trade the structure and support and resistance. So you can technically trade the fake outs or can trade the breakouts for a few cents of bounce, where you cannot get squeezed or trapped in any position. So for example here, let's take this for example, in the pre-market, we have a high here, and I believe that most of retail traders look at this high for a breakout. And as you can see, the first breakout happened of this. It was a few cents and reversed back to wash them and then bounce back again. So technically, if you watch this level and you take advantage of the level 2 and you see what's happening of this, sometimes you get an opportunity. You get an opportunity of this price to buy a few cents and get out, and then wait for the market to react. And if you the indication here from time and sales and the level 2 will show you who's really waiting here. You will see probably big bidder here waiting, and the prices just move back to flush, and then the big bidder was waiting there again to push the prices higher. So you can see those bidder who's interacting at these levels, so you can actually judge it if it's a fake breakout or it will actually break out to the next areas. And we usually scalp those few cents, and if I have a strong target like a value or an area that I can trade against, I scale out and I wait to reach my target to maximize my my profit on the position. Coming next, we trade our usual setups, the B2, T2, FT2, B2. This is the things we discuss in our course. So for example, this FT2 here, if I take my Fibonacci and I'm trading this market, I can technically scalp that very easily. If I see the bounce, I see it started here first with the T2 and then B2. So we have a setup of FT2, B2. So technically I should draw the Fibonacci here. Yep, and drawing the Fibonacci on this setup will give me a key levels that I can play against. Here, for example, the 140 and the 153 and the 176. And you can always trade against those levels or around it. And as you can see, it hit the first target, it hit the second target. So if you have here's another FT2 B2 here, and if you can plan, for example, if we're trading out setup on a scalping system, I will wait to see the bidders actually going aggressive at 129. I see a bid size pushing, whether a bid size or a hidden buyer, you can tell from time and sales. Whether I see them, I just jump on a trade and try to capitalize on this move, and I won't come out unless I see the sellers pushing big size and moving the market. So sometimes the sellers post their sizes there, but they cannot actually take the market down. So in this case, we still have a hidden buyer who's pushing in our favor, and we keep holding till we get the reversal that we want. So we catch the move, we're out on reversal. Trading our setup, of course, will give you a good indication if you went through our course. Next, we'll discuss the VWAP, the volume weighted average, the line we see here. We can see the size here of sorry, we can see the VWAP here. The VWAP is where institutions, hedge fund traders rely on, and HFTs, the automated programs, and all of that. So we can always take, it's not a moving average, it's the relation between volume and price. So usually if the price under the VWAP, that means the most volume is going on the short or sell side. If the price is above VWAP, that means the volume coming mainly to the upside or the buy. But usually we have interaction between prices and VWAP, whether consolidation up and down or bounces. Bounces like reaction. If it's coming from down to up, usually it interacts with the VWAP, and usually if it breaks the VWAP, it just retrace back again to test around the VWAP and then decide direction. And usually there is a big fight here at the level 2. You will see a lot of sellers and buyers coming clashing on the level 2. A lot of sellers. Usually I take the bounces, but I cannot identify a clear direction of the VWAP if I see a lot of fight here on the level 2. So the VWAP has to be considered. Watch the tape during the prices play around the VWAP, and see how to relate the story of the tape with the VWAP, so you can define the coming direction of the VWAP. Is it up and down? Also, we have the wash bounces, the washout bounces like this. So when the market is trending up, usually it tends to wash. A wash like this here, or a wash like this. Let me remove the drawings. A wash like this or a wash like this. Usually in the market trending up and there is buyer jumping on it, the market tend to give them a sense of panic to get them out of their position, or let the shorts actually jump in because they think emotionally that, oh, it's too high, we should get short in here. So shorts jump in, buyers to get out of their position, where the strong hand take advantage of all of that, take the size and start running up. And as you can see, it's not easy to read the tape and take a buy at the bottom of these washouts, but with practice you can actually see what's happening on the tape, and you can capitalize on buying these washes on the upside or the downside. So buying the wash and take advantage of these small fluctuations, because guess what happens at these washes? The buyers usually the big hands getting a better size for the direction, the buyers getting out of their position, and usually when there is a cheaper price for the stronger hand, usually there will be aggressive buying at the low prices, because this is opportunity to buy cheap on the direction of the move. Coming on next, day chart ranges and values. So also one of the key levels that we can use in our favor is the value. I always I never actually suggest or advise trading at the value levels, but really with reading the tape and having enough experience and relating the auction with the tape, you can actually tell what's happening at this value and where the market will push next. So you can take the value advantage as a magnet by taking these ranges up and down between a buy and ask. Or if you can see clearly at the tape, there is an action or a hidden buyer or seller or someone taking control, you can take when is the next push out of the value, and you take advantage of that. And of course we're scalping in and out of the tape on level 2. So if the bidders keep supporting us, I stay in positions. Once I take the bounce and sellers start coming back, I just take off positions and have another view on that range and see what I should do next. Highs and reversal. Usually markets before reversing direction, it gives peaks, like very strong peaks and very aggressive moves. So reading the tape will give you a lead when these moves happening, especially when you seeing the volume here. When you see unusual volume coming on one way, as you can see, the volume kept increasing on the upside here, and suddenly unusual volume came to the downside. That's a sign of reversal, and you can actually trade this down range, and I did many times before, not just on the short side. I traded long and I traded short, because on this downside it's easily to spot whose the longs are squeezed, when's they covering, and whose the shorts are taking profit. You can see this on the tape, so you can, as you have opportunity on the downside to get shorts and get short positions, you can easily make a profit on the upside by catching these bounces for a jump of 20 cents in seconds. It's always easy if you can read the tape. Of course it needs a lot of discipline and risk management, But really in this range you can make as much money on these bounces as you can make on shorts, because in scalping you're focusing only on bites of the price movement. We're not really willing to hold all of this unless you have a plan to go and hold that. That's totally fine. But if you're focusing on scalps and biting of those, you can capitalize on the bounces and flushes during the range. So screen tape and recording your trading day and reviewing it later is a great tool to help you smart practice. And of course you need to repeat the process and try different products, different volatilities, and focus and your goal is to relate what happens in the tape with the auctions and the key levels that you already identified earlier. Coming next, the X patterns, and usually I like to draw structures wherever the market goes, just to show me what retail traders how retail traders acting, where everybody acting, because I usually trade against this setup when it fails. But usually there is interactions at these lines when you draw a solid structure or any pattern. Usually there is interaction. As you can see here, market came, built the structure, and then came back later, kicked through it, and it had to go back and respect that. So you can take the bounces of this line, or you can take a quick breakout of this line, and you can always interact according to what the tape to the level 2 saying. So I know there is this level, there is interaction, so I can capitalize on few cents up and down both directions according to the level 2 on time and sales at this area. And you can tell when the market can make. Here's an area that is playing great, FT2 B2 setup, and structure and a structure as well, and we have a value area. We have many things happening here, so you can easily capitalize on a big breakout like this. So at the price at 144, you usually see big bidder pushing the market like this in your favor, so you keep that in mind. Risk management on these setups, you cannot have more than 1 to 3 cents risk, because we're always aiming for those small prices fluctuations, so we cannot risk too much. All right, now I believe we have a great view on what's happening at the technical side. Of course there is way much more, but here's the last thing on the X pattern. When I have two trends meeting at one point, I consider this area as a value or as a magnet, because this is where the balance area between buyers and sellers. So I always indicate that the prices also interact with these levels as values, the meeting point between the two structures up and down. And yeah, you should keep that's been explained in the course as well. So most of the setups I spoke of today been discussed in the course material. So so far we discussed the LV imbalances, the fake out structure, our setup, the VWAP, the squeeze. When you realize that there is shorts here got squeezed, only patience will give you that edge. When you're patient, you will see exciting positions and people jumped in and the market starts squeezing them, that you know that the shorts here in trouble, and you can capitalize on this move because you know someone is squeezing them. And usually this squeeze, short or long, it comes back with a strong reversal to the opposite direction. So patience will always give you that edge, patience during watching the level 2. So get your screen record, and there is a great YouTube materials. If you go to YouTube, I'll be releasing some videos soon of recorded tape, but if you go to YouTube, search for tape reading videos, you can find a lot of good stuff there to start practicing. And of course, not just scalping or reading the tape, you have to relate that to your structure, the auction volume profile, and your trading strategy and bias and all of that. I hope I gave a clear indication of how this works. It's not easy, it's not for everyone. I advise you to take enough time to practice. Don't rush in execution and jumping on the markets. Risk manage, and give yourself a chance to see results out of scalping before getting to execute real money in markets. You can request a demo from any broker who can provide you with a level 2 and real-time charts, and practice on that. No need to rush. This kind of skill, reading the tape and relating to the market, takes a lot of practice. It took me long hours to start relating the level 2, the time and sales, and what's happening in the market. And especially that we here trade the auction and volume profile, we actually have an edge against a lot of scalpers and day traders, so that's an advantage. Take it on your way. So please, for any questions related, of course we will cover this topic deeper in future videos, but if there is any questions, please email me at livewiretrading.main@gmail.com. Happy to answer any questions. I'll see you in the next trading discussion. Thank you for watching.